If I revalue my asset and I make my asset bigger, the carrying value of my asset becomes bigger, the tax base remains the same. Yeah, this is going back to fair value through P&L investments. This is going back to an hour ago. If you revalue the asset up, the carrying value goes up, the tax base remains the same, and therefore you have a taxable temporary difference, therefore you have a deferred tax liability. This is what the standard says. So we understand the standard. Now let us understand the framework. The framework is obsessed with the definition of a liability. So what is a liability? A present obligation. Right, let's just hold on to that. A liability is a present obligation. A present obligation from a past event, the settlement of which will result in an outflow of economic benefit. But there is a present obligation. When will you pay the tax? What will have to happen before you pay the tax on the revaluation of the property? If you have an asset which you revalue, when will you end up paying the tax? When you sell it. Okay? So if I have an asset which I revalue, I'll only have to physically pay the tax when I physically sell the asset, because then I'll have the cash, then I'll have a taxable gain. Are you presently obliged to sell the asset? No. So let's just recap. The definition of a liability per the framework is a present obligation. A present obligation. So for example, when you put an oil rig up, as soon as you put the oil rig up, you're under a present obligation to take it down. Yeah, because the past event has occurred. So even though you don't take the oil rig down for 10 years, the initial erection of that oil rig creates a present obligation to remove it. If I have an asset that I have revalued, I am under no present obligation to sell it. Because I'm under no present obligation to sell it, I have no liability. One more time. One more time. I say 12, revalue, taxable temporary difference, deferred tax liability, that's what you must do. Be philosophical. Be full of principles. Be full of theory. A liability is a present obligation. You're under no present obligation to sell the asset. Because you're under no present obligation to sell the asset, you're under no present obligation to pay the tax. Ergo, deferred tax is not a liability. Shouldn't be recognised. A framework a liability is a present obligation. Tax on the gain is only payable when the asset is sold. There is no present obligation to sell the asset. Therefore, there is no present obligation to pay tax. So, per the framework, a liability is a present obligation. A tax on the gain is only payable when the asset is sold. There is no present obligation to sell the asset, therefore there is no present obligation to pay the tax, i.e. there is no liability. In other words, there is no liability. So, ACCA 12 knows this and says, actually, deferred tax is a valuation adjustment. ACCA 12 knows this and says, hang on a minute, remember the very first thing that Tom said about deferred tax, and the very first thing that Tom said about deferred tax is that the reason we do deferred tax is the matching process. The reason we account for deferred tax is the debit. I have recorded a gain, so I want the tax on the gain to be recorded in the P&L. And the credit is a bit of an afterthought. Yeah? So the credit we recognise as a deferred taxation liability per ACCA 12. I accept the fact that it is in conflict with the framework, but the reason we account for deferred tax is because of the matching concept. So there's all sorts of headache matters going on here. So we can say here, deferred tax is a valuation adjustment. Deferred tax is a valuation adjustment. Yeah, that is there about ensuring the matching process. Yeah, I mean it results in overstating liabilities. Yeah, it results in overstating liabilities. That's the consequence of accounting for deferred tax, is that your liabilities will be overstated. Yeah, I think that's a fair interpretation. I mean, when you calculate the gearing ratio, you never include deferred tax as a debt, as a liability. Many companies will have deferred tax liabilities on their balance sheets, which they'll probably never pay, but they still have to account for it. I mean, it seems a little bit strange. I'm not going to look at the time. I know it's 5:45, so I know it's very nearly break time, but I have one last recap of what we have been saying. Then we can go for break, come back from the break, knowing that we have ticked the box that is deferred tax. Now, sometimes we talk about a deferred tax liability, and sometimes we talk about a deferred tax asset. And what I want to do is simply tie up the language. So a deferred tax liability is all about taxable temporary differences. So a deferred tax liability is all about taxable temporary differences, which are by and large to do with accounting gains which are not subject to current tax. So if I have a deferred tax liability, it's because I've got a taxable temporary difference. It's because I've got an accounting gain which is not subject to current tax. So for example, revaluations. Now that would include fair value adjustments. That would include all sorts. Anything that makes your assets go up that you're not subject to current tax for. So this is where the carrying value of your asset exceeds the tax base. Where there's a yin, there's a yang. Where we talk about deferred tax liabilities and taxable and gains and revaluations and carrying value of assets being greater than their tax base, it could be the other way around. We could be talking about deductible temporary differences. Never say, I have a deductible temporary difference, so I've accounted for a deferred tax liability. Ooh, no. Yeah, you've got to have a consistency of the language. So a deductible temporary difference, this is going to relate to accounting losses, not yet subject to tax relief. So you're getting tax relief in the future. So this would include things like impairment losses. This would include things like provisions. Yeah? This would include expenses that are disallowed. Share-based payments. Provisions for unrealized profits. Yeah? Provisions for unrealized profits. Share-based payments. Where you've got expenses that are being charged against profit, but for which no current tax relief is being given. This, in other words, is where the carrying value of your asset is less than your tax base. So if your asset is bigger, it's a deferred tax liability. If your asset is smaller, then it's a deferred tax asset. So impairment losses, provisions, PUPs, provisions for unrealized profits. A provision for unrealized profit will drag down your inventory, yeah, but leave the tax base high. So a provision for unrealized profit is another example of a deductible temporary difference. A share-based payment will be an expense that you charge in profit, but no cash changes hands, so you don't get tax relief on that straight away, so it sets up a deferred tax asset. Or you could have the carrying value of a liability, which is greater than the tax base. I have a dream. And the dream is that one day there will be a 25-mark question in a P2 exam which is loosely based around deferred tax. Yeah? And that 25-mark question would have 3 or 4 different accounting issues. So you might have a discussion about impairment, you might have a discussion about revaluations, you might have a discussion about provision for unrealized profits, you might have a discussion about something else. So you would be writing about the revaluation, writing about the impairment, talking about the impact of it on the carrying value, explaining the correct accounting treatment. And then, for a couple of marks, oh, the deferred tax issue is this. Yeah? So the question would be framed around the idea of saying, yeah, discuss the accounting treatment of the above problems and their deferred tax implications. So there would be within a 25-mark question, 6 or 7 marks to do with deferred tax, because you'd keep on having to coming back to a deferred tax. But the question would be also about impairment, revaluation, provision for unrealized profits, I don't know, all sorts of things. And of course, if it is such a big question, there's going to be something in that question that you haven't come across before. But when you think about the deferred tax implications of something, toss a coin. If you are not sure which it is, just go for one or the other. Be completely right or be completely wrong. Yeah? Don't say it's a taxable temporary difference, so I think it's a deferred tax asset. I mean, that's just gobbledygook. All right? So if you're not sure, yeah, think about it. Is it good news? Is it gains? Is it assets? Are things happening? Deferred tax liability. Is it bad news? We talk about expenses, losses, liabilities, problems. Then it's a deferred tax asset. Yeah? Then you've got the... Sorry? Well, I don't know. I mean, finance leases, that's a good one. Because what the issue with finance leases is that you will have both a carrying value of an asset and a carrying value of a liability. But the taxman won't acknowledge either, so the tax base will be nil. So it depends on the way it works. Yeah? Depends on the way it works. So share-based payments, you know, you've got an expense there, but you haven't got a carrying value, so you're going to have a deferred tax asset there. So those are things that you will have to deal with. Have I got time to start the next topic, or is it break time? I think it's break time. I hope I haven't broken you, but I think it's break time. So it's 15:15. So let's take a 15-minute break.